Hi, and welcome to the Adhesion Manager Spotlight webinar. Today is July 15th, 2019. We do have DGHM and Company on the phone today. We have Mike and Jenny, who are going to be taking it away and going through their all cap and mid cap value strategies. So, Mike, if you would please, thank you very much for being here.
Thank you, Patrick. Thanks for the invitation to join Adhesion's platform. We're really excited about it. DGHM is a U.S. value equity boutique. It's a very simple, straightforward story. We do just one thing: U.S. value stocks. We have 6 strategies. All cap, which you're viewing now, is the longest tenured track record at just about 30 years. We were founded in almost 40 years. We were founded in 1982. The thing that you'll find about DGHM strategies across our set of 6 is that they all have very good up capture and superior down capture. So right off the top, if you're looking for a manager that weathers a financial crisis or a tech bubble bursting well, compared to peers and compared to the benchmark, and of course compared to ETFs, DGHM deserves a good long look. We've really distinguished ourselves with good risk management, and as you know, risk management is so important. By declining less and compounding off of a higher low consistently, we have the effect of superior long-term results. The fact is that, the reality is that we, like a lot of active managers, we do our best to keep up during sort of the raging bull markets, but it is our expectation that we will withstand the bear markets, particularly those that are a little bit more extended than 2 weeks or 2 months. If it's a 6-month or a 2-year bear market, you can look at our track record as evidence of how well we've done in the past of withstanding those. So next slide, please. Mission, essentially superior risk-adjusted returns over the long haul. And we achieve this through fundamental analysis. We're kind of a simple blocking and tackling story. Next slide, please. So 3 decades of work since 1982. Second bullet is significant. If you look through the portfolio of holdings of all cap value, one mid cap value, or any of the strategies offered by DGHM, you'll find kind of an eclectic bunch of companies. We tend to sort of not follow Wall Street too much, so you're not going to find PayPal hiding out in this portfolio. And I mention that because we were just looking at a peer manager on one of the brokerage platforms that we work on. It's a well-known value shop, and one of their top holdings, and probably one of the reasons why they're beating us in the current market environment, is they own PayPal at 65 times earnings. You'll never find a stock at 65 times earnings in our portfolio. Down the bullets here, 20% of our equity is owned among the employees and partners of DGHM, and all of the members of the investment team own equity. Next slide, please. Key here is the people. We have a lot of long tenured folks on the investment team. Average experience on the team is somewhere in the neighborhood of about 25 years. Experience working together in our investment team is approximately 20 years. So lots of experience working together, lots of credentials on that team. 8 of the 9 members of the team are CFAs. Next slide, please. You can see here, again, 30 years average experience on the team, 19 years working together as teammates at DGHM. And that's significant because we have a little bit of an eclectic style, structure. We don't have a single corner office sort of generalist portfolio manager that you are probably very familiar with that model. All of the members on that page there, all the individuals on that page are sector portfolio managers, and each of them, the 9 members of the team, each work side by side selecting stocks on each of our 6 portfolios. And to make sure that risk management is paramount and with respect to the attention that we pay, each of our portfolios has a team leader. And the team leader is responsible for day-to-day risk management of that portfolio, making sure that the buys that are being made are adherent to the model, and making sure that any stock that is underperforming by a certain set of standards is being addressed by the relevant sector portfolio manager. Next slide, please. As you can see by this matrix, we have kind of a diversified set of clients, and originally founded as an institutional manager. So, clients were pension funds and foundations back in the old days. And more recently, we've seen the family office business, the wrap and UMA business, and in addition to that, the mutual fund business growing as a part of the total assets under management. You see some representative clients there, some well-recognized institutions and wealth management shops. Next slide, please. So long-term track record, you can see that down in the lower left-hand column, the since inception numbers are ahead of the benchmark. The nearer term has been a challenge, as many active managers have been sort of, searching for that, the elusive, I guess, PayPal that's going to keep them equal with the benchmark performance. But as you look into the 15, the 20, and the 25-year periods, superior long-term performance. And in the box in the lower right-hand side, active capitalization management. The dark blue is small cap, light blue is mid cap, and gray is kind of larger cap companies. And as you can see, we do move around quite a bit over time. We always have some representation from all capitalizations. And because we are focused 30 to 40 stocks, we do have a capacity limitation of about 2.5 billion. In the past, we've been close to that number, and we backed off. And today, we're not too close to it. But we just wanted to assure you that we're going to be very disciplined about making sure that we can manage the portfolio 10 years from now like we're managing it today, and have strict capacity limitations. Next slide, please. This is a really instructive look at what happened to DGHM and what happened to the S&P 500, and therefore the ETF investors during the financial crisis. 6 quarters make up the financial crisis, fourth quarter 2007 to the first quarter 2009, and we were down a really scary 36%, and it felt terrible. The benchmark that we follow, the Russell 3000 value, was down 51%. And as I was mentioning, the importance of not declining as much is so paramount. Because the benchmark was down 51%, they had to make up 102% in order to get above the high water mark. And although we were down 36%, our high water mark was 56% above. We've appreciated 263% since that time. The benchmark has beaten us 302. And so in the period since the financial crisis, 2009, the ending of the financial crisis, we're 263 versus 302, and that's disappointing to us, believe me. But by declining less during the 6 quarters that make up the financial crisis, if you consider the financial crisis along with that 10-year period, we're still 35% ahead of the benchmark. Again, decline less and your clients will be happy with you over the long haul. You can see that it took us 4 quarters to get above our high water mark during the financial crisis. It took the benchmark 4 years, not 4 quarters, it took 4 years. Next slide, please. Again, the testimony of good rolling results, the batting average, consistently above 50%, and in the longer terms, very close to 90% or greater. Next slide, please. As you can see, the 20-year number, so going back to 1999, tech bubble era, we have compounded at 9.9 gross per year, and the Russell 3000 value is about 340 basis points behind that number. You see that by the alpha measurement, 3.4. The standard deviation, more or less in line with the benchmark, not too significant with respect to the departure there. But the Sharpe ratio, the return per unit of risk, we're more than just about 2 times as productive, if you will, as the index's Sharpe ratio. Upside capture at 117% over that 20-year period, and the downside capture of 93%. I will tell you that if the market is in a raging bull market, we would not have the expectation that we will capture 117% of the upside. But by compounding off of higher lows and stringing together enough negative market events, gives us the opportunity to sort of pad that number, if you will. So I don't want any sort of mistaken expectations that we're going to crush during bull markets. We're going to hang in there, and we're going to outperform during the bear markets. Next slide, please. Active share. I won't spend too much time on this slide in the interest of time. Suffice to say that with 30 to 40 stocks in the portfolio, we although our stocks are all sourced from the U.S. market, and they're all between 1 billion and infinity in market cap, we don't bear much resemblance to the benchmark. Our active share is currently 87%. So, in other words, 87% of our portfolio differs from the benchmark. That can be names. We hold up some names that are not in the benchmark, the Russell 3000 value. But probably more importantly, those names that are in the benchmark, we have significant overweights in them. So if you're a 2% name in the benchmark, like JP Morgan, for example, if we want to buy JP Morgan, you're going to come in this portfolio at about a 4% at cost weighting. Next slide, please. To sort of begin the investment process piece, I want to just focus on the fact that DGHM is a fundamental shop. It's kind of quintessential. Roll up your shirt sleeves and look at the company's K's, Q's, try to investigate why this company with good financial performance is a value stock. In other words, why is this stock underappreciated by the market? Next slide, please. This is worth a look. I'm not going to spend too much time here. 6 steps to the investment process. The first step is the idea generation, and that's the output of a 30-odd-year-old multi-factor model. And the multi-factor model is looking for relative valuation. So we don't need it to be the cheapest stock in the market, but we need it to be relatively attractive versus peers. It has to have profitability, attractive free cash flow yield, and has to allocate their capital smartly a measurement that we use is basically in the capital efficiency category. Next slide, please. This is essentially what I just described, the idea generation. This is the colorful box is the multi-factor model's output. So the multi-factor model is going to look at a universe of approximately 1,500, 1,600 U.S. Stocks that screen as value stocks. 100% of those are, the Russell 3000 value names make up probably, I'd say, about 90% of that universe. We have the flexibility to look at broken down growth names that still might be in the Russell 3000 growth bucket, if you will. Russell hasn't recategorized them as value stocks yet, but immediately upon devaluation of that stock's price versus peers, we have the flexibility to look at it as such. So this is basically a universe of about, I'd say, 1,500 stocks. In the green area, ultimately, we're going to be looking at approximately 400 stocks. So those 400 stocks possess attractive relative valuation. They're attractive profitability, attractive free cash flow yield, strong balance sheets, and they allocate capital well. Those are the essential factors of what we're looking for. They all have that in common, and we're going to buy approximately 1 out of 10 of those 400 stocks that make up the buy section of this multi-factor model, 1 quartile of the universe. Next slide, please. So after we've sort of made our first cut and we've got 400 total stocks to look at, we're going to look at sort of the essential fundamental items that you're familiar with respect to a value manager. We're going to look at kind of its market position. We're going to look at the company's fundamentals. We're going to really look at free cash flow. We're going to look what they do with the free cash flow. We like companies that buy their own stock back. We like companies that reduce their debt or restructure their debt at more attractive rates, or pay their shareholders a dividend. Those are favorably viewed by our model. Our model doesn't like companies that are highly acquisitive, that are taking that money to buy other companies, or investing heavily in R&D. It's not to say we don't like companies that innovate. We just don't want to be buying them when they have a big R&D spend. We prefer to buy them after the stock devalues, after sort of digesting that R&D spend, and companies about ready to reaccelerate in our vision based upon the investments that they've made, but the stock price is depressed. That's kind of the quintessential DGHM holding. Next slide, please. So with 9 members of the investment team, there's ample opportunity for kind of wayward behavior. 9 individuals doing nine things. So to constrain that, where we have 9 individuals doing really one thing, they're buying stocks that are screened as buys on the DGHM model that's been in place for 30 some odd years, and those stocks have certain commonalities, so that whether you're looking at a trucking company or a restaurant, they're all going to have high levels of free cash flow. They're going to be relatively attractively valued versus peers, industry peers. And then rather than having 9 individuals be able to just sort of plunk names into the portfolio, they sit down as a team and discuss every single name collectively. It's not voted on. That the ultimate investment responsibility is of the sector portfolio manager. So if it's a buy on the model and they have presented it to the investment team and they have addressed all the investment team's curiosities and questions and critiques about their model, they have the freedom and flexibility to buy that stock, even if there's disagreement, even if the CIO says, I hate this company. If it's a buy on the model and they've satisfied those responsibilities, they can put it in the portfolio. Now, if they don't listen to the feedback and the feedback is borne out down the line, they've cost themselves some money, because their compensation comes in the form of how much alpha they generate. So we're keeping track of down to the penny how much alpha is generated in each portfolio by each of the 9 members of the team. And if you're having a great year, you're going to get proportionately greater amount of the incentive compensation paid to the team. Next slide, please. 30 to 40 names, again, DGHM does not really market time significantly. We're usually about 3-4% cash at the most. We also don't sector time. So you will not wake up and find that you own a financial services fund. You won't wake up and find that we are 30% technology because we think it's attractive or whatever other consideration might go into that. You will find that if tech is 10% of the Russell 3000 value, DGHM will be between 7.5% and 12.5% technology pretty much all time. So we have sector bands that keep the portfolio somewhat constrained, gives us enough flexibility to move around our bullish and bearish sentiments regarding sectors, but it doesn't give us the flexibility to turn into a sector fund overnight. Next slide, please. Risk control, something that's really, given a great deal of attention by DGHM. We are diversified by stock. We're diversified by sector. There is limited key person risk. So if Mario Gabelli up and leaves, actually, bad example because he's not as engaged as he once was. If a corner office PM leaves his or her shop, they're out shopping for a new corner office PM, whereas at DGHM, if an individual leaves the investment team, as happens from time to time, last time was about a decade ago, so very little turnover on our team. If they do happen to leave the team, we have, at the present time, 8 other team members that can make up for their work for a period of time until they're replaced. Daily oversight by the team leader. That's really important. Eyes on that portfolio with respect to risk management every single day, just like you'd expect with the corner office PM model. We replicate that with the team leader function. When do we sell a stock? If it becomes in the red or yellow area on that colorful chart from a few pages ago, reflecting the model tells us when it's time to move on from an idea. Deteriorating fundamentals, that's also going to show up on the model in all probability. But we generally don't need the model to tell us that the fundamentals are deteriorating. We can kind of glean that by our constant communication with the company. And then very importantly, we have a value trap sell discipline where if the company finds its way into our portfolio and begins to underperform, if it spends approximately 9 months underperforming the market, and by underperforming the market, specifically in the 4th quartile of relative performance versus industry peers, so comparing a trucker to another trucker, for example, it is voted on whether or not it stays in the portfolio. Next slide, please. I'm going to skip this one in the interest of time. Next slide, please. You see our top 10 holdings, and as I mentioned, some recognizable names. JP Morgan is something I mentioned at 4.3 weight. You see it's a large holding. It's a large constituent of the Russell 3000 value, which accounts for its weight in this portfolio. Xcel Energy, Torchmark, Howard Hughes Corp, a little bit more eclectic. If you look at the entire list of holdings, you'll see that there's quite a variety of names in their portfolio. So ultimately, you give a client some really, really broad value exposure by holding DGHM's all-cap value. Next slide, please. In the gray shaded area, you see the essentials of what I'm talking about when I talk about the multi-factor model. valuation, profitability, and financial strength. We're looking for sort of the nexus of positive growth characteristics, attractive valuation, and good sort of interest coverage down at the very bottom, the financial strength. Next slide, please. Here's all the holdings in the portfolio at the current time. Again, between 30 and 40 stocks is typical. 30 to 35 is more typical than above 35. Next slide, please. Fees, pretty self-explanatory. These are for our institutional separate accounts, and Adhesion has special negotiated rates. Next slide, please. So just a quick summary, people, process, results. On the people side, really seasoned professionals, 19 years of experience working together at DGHM. You're not going to find that number as an average at any firm of investment team members working together. So lots of experience working together, lots of total experience, 30 years average experience as stock pickers are in the market. Process, time-tested and proven discipline that has its best effectiveness, I would say, at outperforming during bear markets. And the results, you can review the deck and see good long-term results. And I'll pause here and say that in addition to all cap, the DGHM mid-cap value is also on the Adhesion platform, and that is another long-term sort of proven winner. It's having a good run currently. The long-term results are also excellent. The investment process that I described, where in all cap, where we're looking for relatively attractive valuation, profitability, and capital efficiency, that is also true of mid cap. No deviation from that at all. The only difference here is that, as you'd guess, we are constraining ourselves to mid-cap size companies. So no big caps, no small caps in here, just that mid-cap sector of the market. And Patrick, could you toggle forward to the performance page, please, in mid-cap? Back one, please. There we go. So the long-term results, 12.5 versus 11.5. You see the rolling numbers here. The 20-year is probably the most favorable. The 25-year and the since inception. In the current year-to-date, we're enjoying very good results versus the Russell mid-cap value, almost keeping up with the mid-cap, which includes growth stocks. So you see 2 billion to 35 billion, again, 30 to 40 stocks, so fairly concentrated and very disciplined about sticking to our time-tested process, which sort of inures us during difficult markets. So with that, I'm going to conclude. And Patrick, if you have any questions for me, let me know. Otherwise, I'll just say that thank you for considering DGHM. If you have any questions, on the front page of the decks, my telephone number and email address, and Jennifer Schwartz's telephone number and email address. And Jennifer and I work together as a team covering all clients. So feel free to follow up if you'd like.
Mike, thanks so much. That was fantastic. Really appreciate your time today. Did have one question come in here. So wanted to know that on slide 17, this 30 to 40 stocks for this all cap product, this works really well within the Adhesion's UMA environment. Just wanted to point that out and mention, so within the context of an overall, say, broader portfolio, what role do you see your all cap value model really playing?
There's a couple of possibilities. All cap is really sort of core U.S. value allocation. So if somebody has profits to trim from growth and needs something to do with it, that is sort of a relatively attractive arbitrage currently for I wouldn't say smaller accounts because we've got plenty of big accounts, but for accounts that want to hold one value manager as opposed to a small cap manager, a mid cap manager, a large cap manager. We're going to own small cap stocks, mid cap stocks, and large cap stocks. So it's really sort of like ideal for somebody that doesn't want to own 150 U.S. value stocks in order to have a value exposure. 30 stocks gives you small cap, mid cap, and large cap value exposure. So, you know, can really think of it as a core value exposure. A few years ago, when we had better performance, frankly, you know, and it's been difficult recently, but things are cyclical. We'll get back there. We have a substantial amount of our own money in the portfolio. A few years ago, folks would pair us with all cap growth strategies, and that would be the extent of their U.S. Equity exposure, an all cap growth and an all cap value. That works pretty well over the long haul. So if you have the capability to model that out, take a look at how an all cap growth and all cap value manager work together versus the benchmarks, especially if you include the financial crisis period. It's 12 years ago now, but you know, fresh in my memory, and something like it, hopefully not the scale of it, is probably looming out there. So anybody that values risk management and doesn't want to own, you know, too many securities in a client's account, it's probably an appropriate choice.
Thanks. Sounds like a really efficient use of portfolio percentages for that value space. So thanks very much. Really appreciate your time today, Mike. This is fantastic. And if anybody listening has any questions or wants to learn more about DGHM, how they do what they do, again, we have contact information here. It's also available on DGHM's website, or please feel free to reach out to your relationship manager. You can work with me. And so yeah, there's a number of ways to find out more about the model, and we definitely encourage any questions. So thank you very much, Mike and Jenny, for your time today. Thank you again.
Thank you, Patrick. Thank you, everybody.
Patrick.
Great. Thanks so much, guys.